for this section, I'm going to be giving you an idea of what I look for when I am in the market. So obviously, when we are in the market, we are actually looking for a trending market. Okay, we don't want to find ourselves trying to call the tops and the lows. We just want to find a market that is already trending, that we can literally take advantage of the move and just make money. So now, since we are trading in direction of the trend, that is where an understanding of institutional order flow plays a role. So if we are on the daily time frame and on the 4-hour time frame, you want to analyze and know what has been happening. You want to completely understand the story behind what price is doing. You want to fully understand if there are liquidity zones that has to be filled, if there are liquidity zones that have not been mitigated. You want to ensure that there is a balanced price action. Now, there is balanced and imbalanced price action. Now, you as a trader, you want to be able to spot the areas where there are imbalances and take advantage of those areas, because if there is an imbalance where there is a fair value gap, there is a void, there is an order block, majority of the time these things will have to be mitigated. Where there is an equal low or there is a swing high, majority of the times these guys have to be swept. So you want to actually keep in touch with the market and be sure of what's happening, understand your daily narrative. So I want to study the daily time frame and fully understand why it's going up. I want to also know what areas in the market we should be targeting to see responses and possibly take advantage of. And then when I have this idea, I can then run down to the entry time frame, where I will make use of all the technical tools that we have learned to trade. Now, where does fundamentals come into? Fundamentals plays a role on both higher time frame and lower time frame, but mainly on the higher time frame. So quick one. Now, like I said, always try as much as possible to follow the trend of the day. So if we are on the daily time frame and we have a market that is probably trending to the downside, okay, now majority of the time the next daily candle will most likely also trend to the downside, or it's going to push up. I'm going to delete that one. Is either going to trend to the downside, or it's going to probably retrace to form an order block, and then the next candle comes in and continues the move down. This is just what happens in the market. Now, in a situation where we have something like this, we have an imbalance within this area that has to be mitigated. So in most cases, we would always have price retrace until we fill this gap, and then trend can continue downwards. Okay, so this is basically what happens on a daily basis in the market, to which I believe you are already aware. So this is what we'll be looking. If we find a situation like this on the daily time frame, where a fair value gap or an imbalance is in existence, and we find ourselves probably at this point where the market is pushing up, and we are able to understand, okay, we have a fair value gap up here and the market would want to push up probably into it, then we know for that entire day we are looking for buys. At the moment we come into this zone, we know, okay, we have just mitigated a fair value gap. Now the trend downwards can continue, so we can start looking for downtrends. Now, I know all I'm saying now can sound like a whole lot of jargon to you, but don't worry, you just need to have a brief understanding, and then in the coming videos you should start getting more and more better with doing this. So overall, always trade in the direction of the daily trend. Don't fight the daily trend. If the daily trend, if it's hard for you, you want to try as much as possible to predict. Don't just predict, but you want to try as much as possible to know what that day would do. Is the day going to go up, or is it going to go down? You want to be able to predict or anticipate that move. Don't predict, because you are not going to be right at every time, but you want to be able to anticipate the move of the trend. Okay, so if you are anticipating a buy, then you want to go to the lower time frame and scout for opportunities of that buy. If the daily time frame narrative is not so clear for you, then you can always go over to the 4-hour and the 1 hour to get a clear understanding of what is happening. Okay, so now quick one. If I was on the market and I go to the lower time frame to spot a trade, Now, one of the tools that I've always talked about that is always very important is the axial range. The axial range would always give you a kind of an idea of what's going to happen during London and New York. Now, I believe if you should go back to the technical tools, we covered Q zones, the London and the New York Q zone, which are two areas in the market where liquidity is most available. Now, what happens is, majority of the time, the axial range is going to handle accumulation of orders that is then manipulated during London and then distributed in New York. Or in some cases, it just accumulates and then during London, it can distribute but not do so much of the distribution, and then when New York kicks in, the distribution is made complete. What do I mean? Now, we have scenario 1 where this square I draw here is our axial range. The highest point it went and the lowest point. This is what your trading view will always show you. So in scenario number 1, where we have something like this, and at the end, when New York opens, we notice that New York did not break the high. It only swept the high. Now, mind you, this is the highest point. So that means that behind this, we could have price action of something like this. So this here is the highest point the axial range was able to reach. This is the highest point it was able to reach. So now we see that we swept the high here. So this becomes a sweep of liquidity, which I'll tag this as buy side liquidity. So we can say buy side liquidity is taken out, and as you know, in the market, when buy side liquidity is taken out, majority of the time the market has to push down to go take out sell side liquidity. So in a scenario where we have London take out buy side liquidity and starts dropping off, we want to watch out to know the major lows that should carry price up. And what we are watching for is to see how price reacts as these lows. So if price comes in and takes out these lows, then we want, the moment it takes out these lows, what you and I want to do is quickly, idea number 1 is you can use your fib and you want to plot and find out your premium areas to make a sell, for which I will use my GAM box to mark out my 7.5 to 0.5. And once I've marked this out, this is the region I will be monitoring for a trade, and I would quickly get rid of the fib since the GAM box is already here. This is the only 3 regions that is more important, and then from here on you can start watching for price to come into these zones and react. Okay, and now don't just wait for these zones to be your area of reaction. Another thing you can do is, when you mark out this zone, you want to probably go over to the lower time frame or stay on the same time frame that you are on and check this zone within this your 3 zones. Is there a fair value gap somewhere inside, or is there a void? Because majority of the time that is the liquidity the market can be targeting. So you want to find out where there is liquidity, and that is where you want to be waiting for the market. Okay, if the liquidity area is way up in here, then most times you just have to avoid the sell. But if the liquidity area is within your zone, which is the best area to sell, what we marked out here, this region, this 1, 2, 3 are the best areas for you to sell. If it goes past this one here, then we don't want to sell anymore. It's already in a bad area. So for as long as it's within this zone and this zone, it is a good area for you to sell. If you are selling beneath it, you are selling too early. So what we want to watch is where the liquidity is within here, and when we find it, we can easily take a short, or should I say a sell, from that zone. Stop loss will be at the high here, and then you can always target double your risk. Okay, follow your greed. Feel free to target more than that, but for me, in an average trade, I will always target 2:1, and if I get more than that, praise be to God. Then moving on, scenario number 2. If you have questions, feel free to always DM me. Scenario number 2, where axial range gets broken. So this is scenario number 1, where London is the manipulation and then New York comes in New York comes in with the liquidity to drive price down. Now, in some cases, it might not actually you might not actually need New York for this to happen, but regardless, you just take advantage of whatever scenario you find yourself in. Now, scenario number two, where New York distributes, where London accumulates and manipulates, then New York brings in the distribution to the upside. What can you do? Now, majority of the time, what I tend to do is check if there is an order block somewhere in here, okay, or is there an order block at the bottom in here or at this most recent high. Usually it should be within this zone, so that when price comes in, because most of the times when price comes in here, it's going to sweep this zone here, it's going to sweep it and then tap into the zone you marked out, and then it can continue upward. Okay, so what's going to happen here is a sweep, not a break or structure. Mind you, this is what we call a break. This is what we call a break, where the market clearly breaks market structure to the bottom. Okay, but in this case here, what we have is a sweep. So for this one, if I'm marking these out, this here, if I'm marking it out, you can say this was sell side liquidity being taken out. So this is my SSL, sell side liquidity being taken out. So this was sell side liquidity being taken out. Then what I can do in a scenario like this, please don't go into any trade blindly. When we have a sell side liquidity swept, what you want to do is go over to the lower time frame. Okay, when you go over to the lower time frame, you want to see price action of this type, something like this, and then a break of structure to the upside. Okay, then when you have this break of structure to the upside, you can mark out fair value gaps that are within this area. Okay, that the market can then come back into, and then you can hit your buy here, and then it can push up. Okay, now so this is basically your entry. I've given you what to look for and an entry. So this is usually your entry, and yours you can then have for stop loss. Mind you, this trade we are taking here is a trade that is happening on this. This is a higher time frame. This can be your 15 minutes time frame, but this will be happening on the 5 minutes or on the 1 minute. So once you have this, you get your entry on the 1 minute, but mark it out within your 15 minutes. Your stop loss should be beneath the zone that the 15 minutes gave you, which is this low. It should be beneath it. Then you can target 2:1. Try as much as possible to avoid using very tight stop losses, as that's one of the things that kills most traders. Now, in this series, I believe I've given a very simple way to take trades: trend following and reversals, both for sweeps and for continuations. Now, I've given you a way to take trades every day. Follow the trend of the day. More setups are going to come out. This is setup number 1, and let's see if we can find something like that on the chart. So this is my Asia range. Let's go over to the 15 minutes. Okay, let's use the price action from here as an example. So this is the 130. This is 23rd of October. Now, if we go over to the 1 hour time frame, let's look up what happened on the 23rd. Now, on the 23rd, if you look at this from the 1 hour time frame, you see that we have an uptrend, a market that broke to the high side and then it pushed down to the lower time frame. And if you look here, you see how I marked out my order block as the area I wanted the market to come into before pushing back up. And if you continue forward, you see it actually respected it, it pushed up. So anyways, let's come back to here on the 23rd of October. What could we have been doing? Now, from the higher time frame, we know that we are already in an order block where we are expecting to see the market push up. So what we're looking for now is reactions on the lower time frame. So when we go over to the lower time frame, So now overall, if you look here on the 15 minutes, you see that here we have a push down, a push up here that did not break structure, but then price pushed up here, took out structure here. So if you were here on the 15 minutes, what you would have seen is a higher high, higher low, higher high, right? And then do we have a fair value gap in here? Yes, we do. Let me first of all, if we have, do we have a fair value gap? We have a fair value gap in here within this zone and this zone. This is my fair value gap in here. So let me quickly delete this one just so that it's a lot cleaner. So this is my fair value gap, and you see that this is the Asia range. As you can see, it has been ranging, and then what happens is after the range in the morning, you see it pushes down. This push down is to fake traders out. This is the manipulation to make people think the market is going down. Meanwhile, what it's doing is just to fill this fair value gap. It has filled the fair value gap in here. That is the same thing with the sweep we discussed on the first setup, and after it sweeps, it pushes up. So how can you take advantage of this? Majority of the time you would have to go over to the 5 minutes or the 1 minute. For this, let's just go over to the 1 minute. This is 30th of October. So let's find our way back to the 30th. Okay, we're close now. "30th of October." Yeah, that's it there. So this is the zone. So what we're looking at is the moment price hits the fair value gap. So we're watching to see how price reacts in there, and as you can see here, it's had lower highs, lower lows. This was the most recent lower high in here, and price pushes down, pushes up, breaks this high as well in here. So at this moment, what we'll be looking for is a fair value gap. On this one, we didn't actually have a very clear fair value gap. The only one we had was the one in here, which was very small. As you can see, we just mitigated it here. Then this push down here was the one that mitigated just this high in here, mitigated the high. So we didn't have a clear pattern for this one, but this is a fair value gap that you would have taken advantage of if you saw this happening. So another thing here that you would have traded is a breakout block. I know we didn't cover how to trade breakout blocks in this section. Majority of the time, how I trade breakout blocks is when I notice, okay, this is an order block that should have been respected but wasn't respected. What I do in this scenario is when I find price breaking it, I just enter a buy at the top of the breakout block and my stop loss beneath it. So if I was in this scenario, I would have been buying here and my stop loss beneath this last push down here, or I can even use the low here. Okay, so you can just use that to be safe and target my 2:1, and you see it happen neatly. So that's basically a very nice example, although I would have loved it if it pushed down. Now, is there a reason why price did not push down? Yes, there is. If you look at this price action, you don't see any fair value gap here. It's so clear, it's so clean. This is what we call a balanced price action. So there was no need for the market to push down. Market would have pushed down if there was a fair value gap here. The only thing we had here that was a part of liquidity was this breakout block, but this proportion block. But then again, another thing I noticed is that the proportion block is actually too deep within structure. So if we put from here to here, you see that the proportion block is far down, so it's not really in a good area. So that was one of the reasons why price did not bother to push down. There was no liquidity areas here to be triggered. And then another one is the fair value gap created here that wasn't mitigated, and price just pushed away from it. So basically, there are, like I said, always find a way to enter. So entry number one we had here was, the only entry we had here was the breakout block. Another entry we had was a small fair value gap in here. And those were the two entries. So when you get to the lower time frame, always look for either your fair value gaps, look for a breakout block, or look for an order block. 2 or 3 of them are very good areas to enter. Another area to enter is a high like this. What makes this high a criteria? If we have a low that was formed and then this high retests the high, I can also make this high an area for me to enter a trade. Okay, stop loss will be beneath this, so it's a wide stop loss anyways. Stop loss will be beneath this zone, and then you just target 2:1 like I thought earlier. So it's the same rule, whichever one you decide to choose. If you went for this one, it would have still been a good trade. Overall, it would have still been a good trade. Okay, so these are basically entries that I would use. So on this one, we have covered setups and we have covered entries. Now moving on to the second entry, I believe I saw something for that one on the 2nd or on the 1st of November. So this is it. So now if you look at this, you see that we have price consolidate on through Asia, and then it pushes up and then it breaks Asia. What we're watching at is how it breaks. So now if you watch this low, you see it's a clear break. It's a very clear break. So it did not sweep. What it did was a clear breaking to the downside, and then in that break we had this fair value gap that formed here. If you zoom in, you see we have a fair value gap within this region to this region. So we have a fair value gap in here. You can even push it down to this area, but for me is here. So this was my fair value gap. Okay, all of this was balanced, but this is where we have a fair value gap. So like I told you, this fair value gap becomes my entry. Sell here, stop loss at the high here, and we target 2:1. Sorry, and we target 2:1. That's 2:1. And as you can see, you see how price goes neatly and tags us with our profits. Now they are going to be losing trades. Don't think that every trade is going to make you money. Some trades will decide to collect money from you. So not all entries are going to work. But as you can see, this is nice. Now we have a fair value gap. We also have a proportion block here. So if you decided to go for the proportion block as your entry, that would have also worked. But for me, I preferred the fair value gap. I just want to follow what I prefer, what I see more. We still have more of a breaker block in here as well that would have also served as your entry, but that is not what we are here for. So anyways, we have already covered two of this. Feel free to back test, give me feedbacks if you are able to spot this, and if you're not able to spot them, let us know how we can help you. And I hope this particular session really impacted someone. See you on the next video.